Hi, my name is Dean Mosher. Welcome to What is an Option Worth? The many faces of volatility, since volatility is perhaps the most important factor going into determining the value of an option. And we're also going to get into the true meaning of the VIX. All right, well, let's start with a question. Imagine you buy a new $1,000 laptop. Okay, and the salesman asks you, as he often does, if you'd like to buy a service contract. So if anything goes wrong in the next 2 years, you don't have to bring it in to be repaired. They will replace the computer immediately. Do you buy it? Well, the most intelligent answer is it depends. It depends on how much that service contract costs. You can't really make a decision as to whether you want to buy it or not until you know how much it costs. To give an extreme example, if they'll sell it to you for a penny, well, then I would buy it. But if they want $200 or $250 for it, as they typically do, forget it. So, as a general rule, would you want to be a buyer or a seller of service contracts? Well, as we said, it depends on the price. There's really no inherent edge in being a buyer of insurance or a seller of insurance if you don't know the price. Okay, it depends on the price, which is advantageous. Once you determine the fair value of an insurance policy, service contract, or an option, if you can sell it for over fair value, then you have an edge. If you can buy it for under fair value, then the edge is in buying. Okay, it's the same in Las Vegas. The house knows the fair value of each bet, and it sells each bet for a little more than fair value. And that's, if you go to Las Vegas, you see the wealth there. That's what built it. Okay, so as we said, an option is also a bet, and an option is an insurance policy. So is it better to be a buyer or a seller of options? Well, again, it depends on the price. It depends on whether that option is priced over fair value or under fair value. Okay, so whether you're just buying options or selling options, or whether you're doing spreads, whatever you're doing in order to trade options successfully, you really have to have an understanding of how options are priced. All right, so without further ado, let's just plunge right into the most fundamental question in all of options, namely, what is the fair price of an option? All right, well, let's start off with a simple example, a 120 call, a 120 IBM call in our example, which is the right to buy IBM at $120 a share. And I've put this price line down here just to help you visualize what I'm about to say. Remember, we're talking about the 120 call. All right, if I buy a 120 IBM call, that's a bet that IBM will go up. It's specifically a bet that IBM will go up and will expire at expiration. IBM will be above 120. Okay, the more IBM rises, the more money I make, right? Because IBM is the right, an IBM 120 call is the option to buy IBM at 120. So if at expiration IBM is at 125, I can exercise my call, buy it at 120, sell it at 125 because in the open market, and make $5 minus whatever I paid for the call. If at expiration IBM is at 140, then I can exercise my 120 call, buy IBM at 120, sell it at 140 in the open market, and make $20. Okay? So the more IBM rises, the more money I make. So to know the fair price of that 120 call, I really need to know how likely it is to go up. I need to know how likely it is to go up to 125, to 130, to 135. And in fact, I have to know the likelihood that at expiration IBM will be at each possible price. Okay, this is the theory upon which option pricing is based. Okay, I need to know the probability that at expiration will be at 125, at 130, at 135, etc. Well, why do I need to know all those probabilities? Well, it has to do with understanding the expected return of that option. The expected return is the fair value of that option. It's the fair value of any bet. And to calculate the fair value of an option or any bet, what you need to know is the probability of each possible outcome and the payoff of each possible outcome. Okay? Now, it's easy to figure out the payoff of each outcome. Outcome meaning where IBM is at expiration. If I buy this 120 call and IBM is at 125 at expiration, the payout is $5. If it's at 140 at expiration, the payout is $20 because I buy it at 120, exercise my 120 call, sell it at 140, and make $20. But I put question marks for the probability. What is the probability that IBM will be at 125 at expiration? What is the probability that IBM will be at 140 at expiration? Well, that's what our pricing model is designed to figure out. Okay, so let's go over option pricing briefly and talk about how our option pricing model figures out those probabilities. So again, imagine IBM is at 120. What determines the value of a 120 call? Well, here are all the inputs that go into our option pricing model, let's say Black-Scholes, and you put them all in and out pops the price of the option. Now let's go over those inputs a little bit. First of all, we need to know the price of the underlying, right? All right, if we buy this 120 call, if IBM is at 105, it is less likely to be at 135 at expiration than if the underlying is at 120, right? Because it has much further to go from 105 to 130. So we have to know what the price of the underlying is. We have to know the exercise price, also the strike price of the option, in this case 120. The option, and we have to know if it's a put or a call. We have to know we're talking about a 120 call, right? We have to know the risk-free interest rate. This is a cost of carry calculation and really has very little to do with what we're talking about today. So let's leave that aside for now. We have to know the days remaining. I put 62 here. It's just an example. However many days remaining there are, we have to put it in. Why? Because, well, the more time remaining, the more this option is going to be worth. Let's say IBM is at 105. This 120 call, if there's 1 day left till expiration, then this 120 call isn't worth very much because it's not very likely that in 1 day IBM is going to go from 105 up to 120 and above. But if there's a year left, well, there's a pretty good possibility. It's certainly possible in a year that IBM will go from 105 to 120 and above. So obviously, if there's a year left in the option, it's going to be worth more than if there's just a day left. And finally, we have to know the average daily price movement expressed as volatility. We have to know how much IBM on average is moving in a day. Why is that important? Well, let's imagine that there are, let's say 60, well, let's imagine there are 10 days remaining till expiration. Okay. And IBM is at 105, let's say. And I buy a 120 call. So in those 10 days, in order for this option to be worth anything at expiration, IBM has to go from 105 to above 120. Well, if IBM is moving $1 every day, up or down, let's say, an average of $1 a day, it's not very likely that in 10 days IBM is going to go from 105 up to 120. But if it's moving $10 a day, well, then it's highly likely that IBM will go from 105 up to 120 at expiration, right? So I have to know this volatility. I have to know how volatile this stock is, how much it moves every day, okay? All right, let me give you a demonstration, sort of a practical mechanical demonstration of how this works. Okay, in theory, the price movement of IBM or any security is a random walk. Okay, now let's leave aside the question of whether that's true or not. But for mathematical convenience, for purposes of the pricing model, it's a very good assumption to make. It's very convenient. It works very well. So let's take a look at this for a moment, and then I'll explain to you what this has to do with option pricing. All right, what are we looking at here? Well, we see that there are balls dropping from right here, and there are, it's a little difficult to see, but there are 10 rows of pins. And when the ball hits the first pin, it has a 50% chance of bouncing to the right and a 50% chance of bouncing to the left. And then it gets to the second row, and once again, it has a 50% chance of bouncing to the right and a 50% chance of bouncing to the left. And the third row, and so on through 10 rows. And you can see that given that, it is most likely that the ball will end up right where it started, and a little less likely that it'll end up to the right, or a little less likely to the left. And the further away from that point of origin you get, the less likely it is that the ball will end up there. What does that have to do with option pricing? Well, this shows a normal distribution, a bell curve, and it closely represents the distribution used in option pricing, because according to our theory, let's say this ball is IBM, and each row represents a day in the life of IBM. Okay, so IBM starts here, and on day one there's a 50% chance it'll go up and a 50% chance it'll go down. And then on day two there's a 50% chance it'll go up and a 50% chance it'll go down. And the same is true on days 3 through 10. And we see that it is most likely that after 10 days, IBM will end up exactly where it began. I superimposed a price line here, so just for convenience sake. Let's say it starts at 120. It's most likely to finish at 120. It's a little less likely to finish at 121 or at 119, etc., etc. Okay, so the more days remaining, the more likely this ball is going to end up over here or over here. Okay, and that represents the fact that the more days remaining, the more time remaining, the more, let's say, a 125 call would be worth, because the more likely it is that IBM would end up to the right of 125, above 125. Now, what about volatility? How does volatility fit in here? Well, volatility is represented here by how far this ball bounces each time. Okay, if the average daily price movement. Now, let's say that instead of steel balls, we used a super ball. Okay, now this would be more volatile. Instead of moving like $1 to the right or the left, it might move $5. Okay, so it would bounce here, and then in the second row it might bounce here, and you can see it would be much more likely for the ball to end up after 10 days, after 10 rows of pins, either way over here or way over here. Now, this is a normal distribution. In option pricing, we actually use a log normal distribution, which takes into account the fact that options cannot go below zero, but they can go up. I'm sorry, that IBM can't go below zero, but it can go up infinitely. But for our purposes today, this is close enough. Now you can see that we don't have that many balls, so the more balls you have, the more perfect this bell curve is going to be. We don't have that many balls, so it's not very perfect. But let's see what happens if we did this with a lot of balls, thousands, tens of thousands of balls, as in grains of sand. All right, so take a look. This is the same thing using grains of sand, tens of thousands of grains. Each grain is a ball. And watch carefully because this is quick. There you go. Look at how perfect that is. Okay, that's our normal distribution. Okay, but that brings up a question. In option pricing, which volatility are we going to use? Okay, we know what the price of the underlying is. We know what the strike price of the option is. We know how many days remaining there are. But what volatility do we use? Are we going to input the volatility that has existed over the last 3 days, over the last 10 days, over the last 50 days? Well, as it turns out, the correct volatility to use is the volatility that's going to exist between now and expiration. But obviously there's a problem, and that is that we don't know. We can't look into the future and know what that volatility is going to be, can we? So what options traders actually do is they work backwards to get the volatility, because there actually is a price of the option in the marketplace. Okay, every day the IBM 120 call closes at some price. So if we take the price of that option and use that as a given and turn volatility into a variable, then we can try out different volatilities. We can solve for volatility, or what we really do is we try different volatilities until we get a volatility that will produce a price of the option that's identical to the actual price that the market is using. So in other words, the market is if let's say it closes at the 120 call closes at 30 and a volatility of 27% produces a price of 30, then the market is implying that 27% is the correct volatility. It's implying that 27% is going to be the volatility from now until expiration. So that's called the implied volatility. And let's see how that works actually. Okay, here's an Excel spreadsheet which is actually set up to set up with an option pricing model. So on one day, IBM closed at 114.41. The IBM 120 call closed at 664. So let's see what volatility I would have to put in order for the theoretical price to match the actual price that day, $6.64. Now I started out with a volatility of 25%, and that produces a price of $2.52, $2.52. That's too low, isn't it? Let's try 50%. Okay, 50% is closer, but it produces a theoretical price of $7.06. That's a little too high. That's higher than the market price of $6.64. So let's try 47. Very close, just a little too low. How about 47.77? Bingo. Okay, if I put in 47.77% and all the other inputs, correct inputs, my Black-Scholes pricing model gives me a theoretical price of $6.64 for the 120 call, which is exactly the same as the actual market price of the 120 call. So what the market is saying, by pricing the option at 664, it is implying that the correct volatility to use is 47.77%. And you could say that it's implying that the volatility of IBM between now and expiration is going to be 47.77%. Now, in reality, we don't really try out different volatilities until we get the theoretical price. We let the computer do that. Okay, so the way we would really do it is, let's say it settled at 7, we would put it in and our computer would figure out that the implied volatility was 49.7%. If we put in 664, the computer figures out that the implied volatility is 47.77%. Okay. Now, how does implied volatility go up and down? Well, simple supply and demand. And let me show you how that might work. Let's say this is the IBM 120 calls book. This is the supply and the demand. Okay, here are the prices. Here are all the bids. Here are all the offers. Okay, so we see we have 18 people want to buy 120 calls at 664, or maybe one person wants to buy 18 calls at 664. There's 61 calls bid for at 662, etc., etc. Okay, and 66 are offered at $6.66. All right, so let's imagine that during a certain period, IBM doesn't move from 1441, it just stays there, IBM itself. But there's a big order to buy 120 calls. Somebody comes in with an order to buy 10,000 IBM 120 calls. Well, what's going to happen? Well, first of all, these 66 are going to be bought up, okay? They're offered at 666. Then these 73 are going to be bought up at 668. Then these 65 are going to be bought up at 670, 672. Then these 90 are going to be bought up at 674. And in an instant, the price of the IBM 120 calls went from 664 up to 674, and IBM didn't move at all. So let's see how that works. All right, so it's the price of IBM was 664. It got bid up to 674. So my implied volatility, which was 47.77%, goes up to 48.3%, right? Because now the market is no longer implying that 47.77% is the volatility you should be using. The market is implying that 48.3% is the volatility you should be using. What if it gets bid up to 7 even? All right, now the market is implying that 49.7% is the volatility you should be using. What if it gets bid up to 10? Well, now the market is implying that 65.77% is the volatility you should be using. Okay? So if an option's implied volatility goes up, what we can say for sure is that demand for that option has gone up. People want to buy that option more than they did before. That's for sure. Now, why do they want to own? Why has the demand for that option gone up? Well, we can talk about that. There are different theories, and we're going to talk about that. But those are just theories. What we know for certain is demand for that option has gone up. How high does implied volatility get? And how low? Well, let's take a look at the history of stock index implied volatility. Let's look at the VIX. Okay, the VIX is a very, very interesting index for those of us who are interested in options, because VIX stands for Volatility Index. And what it is, it's the implied volatility not on IBM but on options on the S&P 500. Okay? And the VIX has been kept. There have been some changes in it, but it's been kept continuously since 1990. And here we can see the history of the VIX, which is, again, it's an index, it's a weighted average of the implied volatility on all the options traded on the S&P 500, the SPX options actually. All right, so we can see that the lowest it's ever gotten is about 10%. It doesn't seem to get much below 10%. Maybe just a hair below here, but it just keeps bouncing off that 10% level for a period of years here. And then there was a more volatile period. Then it came back down and started bouncing off that 10% level again. And that indicates a lot of complacency, right? And then there are panicky moments when the VIX has spiked up, never got over 50%. 4 times it got up to 50%. This is 9/11 right here. Until September of 2008. Finally, it broke through that 50% level, went almost up to 90%. Now, what does that mean in terms of actual option prices? Well, imagine the S&P 500 is at 900. Okay, and you want to buy an 850 put with 30 days remaining, 30 days to expiration, this stands for. All right, so on average over the past 20 years, how much will that or an equivalent put cost? Well, let's take a look at our Excel spreadsheet. All right, when the VIX is 10%, and let's say that 850 put would cost maybe about 10% implied volatility, with the futures at 900, that 850 put with 30 days remaining would cost a little under $11. However, when the VIX got up to 90%, and let's imagine that that 850 put was trading at 90%, it's not exactly right, but very close. The cost of that put would have risen from $10.81 to almost $3,500. Look at that difference. That's an incredible, incredible difference. So during these times, when the VIX is down at about 10%, options are extremely cheap. Here, when options, well, let's say when they got up to 50%, options are many, many times more expensive than they were, 144 times for this particular option. When it got up to 90%, look at how expensive options became. So I will just use this to make a point that if you trade options, you really have to know the implied volatility of the option, of the options you're trading. And you really have to know something about the historical range of implied volatility of those options. Because without that, you're trading blind. I mean, if you're just blindly buying an option, wouldn't you like to know if it's more towards the low of its range, 1081, or more towards the high of its range at $3,300? It's vitally important to know. All right, well, what might cause implied volatility to go up or down? Well, we've already said that it's supply and demand. But according to our theory, well, why would somebody want to buy more, pay more for an option, or be willing to sell an option for less? Well, let's first talk about what the theory says, and then maybe we'll talk about, where the reality differs from the theory. All right, if an 850 put has an implied volatility of 90%, then we said it's fairly priced if volatility between now and expiration ends up being 90%. Okay? And if that put has an implied volatility of 10%, then it's fairly priced if volatility between now and expiration ends up being 10%. So according to our theory, the implied volatility, you could say, is the market's best guess as to what volatility will be between now and expiration. Because theoretically, if implied volatility goes up to 90%, then the market is anticipating the true volatility will go up to 90%. And theoretically, when implied volatility goes down to 10%, that's the market anticipating that true volatility will also go down to 10%. So theoretically, if people are willing to pay more for an option, that means the market is anticipating that volatility will go up. Now that is the standard explanation of implied volatility. It's generally thought of as the market's prediction for volatility, the best guess as to what volatility is going to be. And if implied volatility is 40%, that is thought to mean that the market is anticipating a volatility of 40%. Okay, that's the way all professors, all academia, most option texts explain implied volatility. But the truth is, there's really more to it than that. Because remember, implied volatility of an option directly measures only one thing, which is how badly people want to own that option. So if implied volatility, IV is implied volatility, if an option goes from 50 to 60%, all you know for certain is that the market's desire to own that option has increased. And let's look again at Excel, and I'll show you that. Let's imagine, let's say, our price is $10 on this option. Okay, which is about 10%. Again, we're talking about the 850 put with 30 days remaining. The futures are at 900. So, around these times when the VIX is at 10% or a little below, that's a realistic price. That's about how much this 850 put might cost. It would actually cost a little bit more than that, but we won't get into that right now. Okay. Now, let's say somebody comes along with an order to buy 20,000 of those puts at the market, whatever the market will bear. All right, and I'm the broker, and I say, okay, who wants to sell you? Anybody want to sell them at 20? No. 30, 40. I'll pay $50 for these puts. Okay, somebody sells them to me at 50. All right. What happened? I just put in the last price of 50, and now implied volatility has gone up to 13.37%. Okay, I've just bought a few hundred contracts. I still have almost 10,000 to go. So I yell out, I'll pay $60, $70, $80, $90, I'll pay $100. You there, I'll pay $100. Okay, so somebody sells me a bunch of those 850 puts for $100. Now implied volatility is almost 16%. I still have a lot to buy. Okay, I'll pay $120, $150. Okay, I'll buy them at $150 from you. Okay, $150. Okay, implied volatility has now gone up to almost 18%. Okay, so that's actually sort of a quick demonstration of, practically speaking, how implied volatility goes up. Now, it's rare that volatility will go up that much, 80% in a day, but actually the implied volatility can move pretty quickly. All right, so let's look a little more deeply at the most important actual reason beyond the theory why somebody might want to buy an 850 put. Now, we said before, well, if they want to buy puts more, if they want to buy options more, it's because they're anticipating higher volatility. But I think it's something more specific than that. And let's really understand that an option is price insurance, okay? An 850 put insures you against a drop in the S&P 500 below 850, okay? Because an 850 put allows you to sell the S&P 500 at 850. So if it goes down to 800, you can still sell it at 850. The multiplier on the SPX options at the CBOE is $100. So an 850 put protects a stock portfolio worth approximately $85,000 against further decline. Okay, assuming the stock portfolio has a relatively close correlation with the S&P 500. If I own $85,000 worth of stock and an 850 put, then if the stock market goes down to 800, the amount I lose on my stock portfolio is going to be approximately offset by the amount of money I'll make on that 850 put. Okay, that's why the 850 put is price insurance. It's crash insurance, you could say. Now, it is true, I mean, I've been talking about price insurance against a drop, but calls are also price insurance against a rise. Some people are short. Let's say I'm short $95,000 worth of stock. In that case, if I buy a 950 call, that will protect me against a rise in stocks above 950. But let's be realistic. Which is more common? Do you think it's more common for people to be net short stocks and afraid the market will go up? Or is it much, much, much more common for people to be net long stocks and afraid the market will go down? Well, obviously, the number of people who own stock and are worried about a drop in the stock market dwarfs the number of people worried about a rise in the stock market. No comparison. So the truth is, every time the stock market drops, the amount of nervousness and fear increases. Every time the stock market goes up, every tick, every minute, every tick up, the stock market breathes a collective sigh of relief. And you can actually see that if you compare the S&P 500 with the VIX. Now here is a daily bar chart of the S&P 500 versus the VIX from 9 of '07 to 9 of '08. And you can see with almost perfect symmetry, every time the S&P 500 goes down, the VIX goes up. Every time if the S&P 500 sort of has a blow off low, the VIX has a blow off high. Again, here the S&P 500 is going down. It has a sort of a climactic emotional low, and there's a climactic emotional rush to buy crash insurance, which causes the VIX, which is the implied volatility, to go up. And then as the S&P 500 goes up, the VIX goes down. People breathe a collective sigh of relief. They're not quite so anxious to buy options anymore. Price insurance, mostly puts, is driving this. And the VIX goes down. Okay, now that was a daily chart, with every chart being a daily bar. It works on a 1-minute chart as well, or even better. Every bar here is a minute, and every bar here is a minute. And you can see that bar for bar, as the S&P 500 ticks up, nervousness ticks down, and that's shown by the VIX going down. As the S&P 500 ticks up minute by minute, the price of options ticks down by the minute. I mean, you can see there is almost perfect symmetry here. And I did not cherry pick this. You can look at any day, it'll be the same. Here's 2 days, 9/2 and 9/3 of 2008. Again, perfect symmetry. As the S&P 500 goes down, the market gets nervous, it starts buying up price insurance, and the VIX goes up. And here's a very recent one, May of 2009. 4 days in May of 2009. And you can see perfect symmetry. It looks like a Rorschach test. It's so perfect. I did not make this up. I chose this at random. You can see that as the S&P 500 goes up, the VIX goes down. As the S&P 500 goes back down, the VIX goes up. So clearly, implied volatility is not just the market's prediction of true volatility for the most part, because it's not that every time the S&P 500 ticks up that people think it's going to be more volatile between now and expiration. No, they're more of, or every time the S&P 500 ticks down, people think it's going to be more volatile between now and expiration. No, they're just a little more nervous, and so they're willing to pay more for options, and that's reflected in the VIX going up. So implied volatility in the VIX is much more a reflection of the market's fear or complacency. Okay, a VIX of 90 is panic and pain. A VIX of 10 is, complacency, calm confidence, not a worry in the world. And sometimes the VIX can give you important clues about underlying market sentiment. Remember, an option is price protection. So implied volatility is the price of price protection. The VIX is the price of price protection. You could say it's the price of crash protection. And really, this is the best way to understand implied volatility. Okay, and one more thing, actually 2 more things about implied volatility before we go. I said before that implied volatility is the best measure of the price of an option, the price of price insurance. Okay. But there's one major difference between stock prices and implied volatility, because stock prices grow over time. Okay, this is a logarithmic scale of the Dow Jones Industrial Average from 1930 to the peak. And in 1932, actually, Stocks sold at the Dow Jones Industrial Average got as low as 41. And over the years, it got up to about 14,000 fairly steadily. Okay, you won't see that in the VIX. You won't see the VIX climbing to 100, 1,000, 500, 1,000, 10,000. That's not going to happen because the VIX represents human emotion, and human emotion can only get so intense, and then it'll come back down. So there is a tendency for implied volatilities to revert to the mean. It may not happen quickly. It's not something you can bank on in the short term, but in a long-term chart, you won't see implied volatility or VIX prices climbing like you see stock prices climbing. Okay, and one last thing about implied volatility before we go. Now, I said before that implied volatility is the most important measure of the cheapness or expensiveness of an option. Now, we're not talking about the VIX, we're talking about the implied volatility of specific options on specific stocks. And I also said that, you're trading blind if you are trading options without knowing the implied volatility. And I want to give you an example of that. All right, the example is our ARNA, Arena Pharmaceuticals, and on 327.09, ARNA closed at 450. Okay, now they had a clinical trial that was about to be announced for a big drug of theirs, and I guess people thought that it was going to be a lot of participants thought that it was going to be positive because ARNA went up and it closed at 450. Now I want you to imagine that you had an inkling, a brilliant inkling, you knew something, and you knew that Arena Pharmaceuticals' announcement was actually going to be negative and the stock was going to drop. So what you did was you bought the 250 puts. Okay, now let's look at the 250 puts here. This is on 327.09. ARNA closed at 450. So here's the April 250 puts. The bid is 60, the ask is 65. Okay, and so you buy them at the ask because you're sure, remember these are the puts, so they're going to go up if Arena Pharmaceuticals goes down, right? Because this is the right to sell at 250. All right, so what happens? Well, it turns out you're right. The next trading day, ARNA, after the close, the announcement comes out and it's negative. Okay, 327 was a Friday, so the next trading day is a Monday. So the next Monday, which is March 30th, Arena drops $1.27, almost 28%. It closes at 323. All right, here's that chart. Boom, big gap, drop and closes, somewhat near the lows, 323. So, you were right. You bought those puts. Let's see how much money you made. Well, as it turns out, those 250 puts, incredibly enough, dropped in value. Look at what happened. The very next trading day, and those 250 puts, which were 60 bid at 65, now they're 15 bid at 25. If you want to sell them, you can sell them at 15, maybe 20. But if you just want to get rid of them, you can only sell them at 15. How is that possible? Well, for the answer, you have to look at the implied volatility. On 327 with Arena at 450, people were so excited about that clinical trial, they were paying so much for those options that the implied volatility of those 250 puts was 443%, which is extremely high implied volatility, extremely high. Volume was 3,800, which is fairly high. The next trade, this is a Friday, Monday, the next trading day, Arena, the results of the clinical trial come out, Arena drops to 323. People are no longer interested in holding those options. They're they sell them. The news is out. And so what happens? Implied volatility drops to 186%. Still high, but way below what it was, 443%. So as a result, even though Arena dropped from 450 to 323 and those puts should have gone up, they dropped. So you can see that if you are trading implied volatility, if you are trading options without knowing the implied volatility, you're trading blind. And even if you get the direction of the underlying stock correct, you can lose money. So that's the presentation. Thank you very much.